Today, momentum, oh momentum, the DFA daily to the 2nd of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Before I start, just a quick update from our live stream last night. Those who took part in the trivial quiz and got the answer right went into a draw, and I'm pleased to announce that AI won. So AI, if you're listening, drop me a note via the DFA blog and we will schedule a free one-to-one discussion on a suburb of your choice. Congratulations. Now let's talk about some of the latest economic news, the latest GDP numbers, look again at the RBA statement, and also ask the question, based on US data, as to whether financial advisors are beginning to recommend cryptos in the main part of your investment portfolio. But let's start with the Australian gross domestic product, which came out today from the ABS and rose 1.8% in seasonally adjusted chain volume terms. That's for the March quarter 21. With 1.8% growth in the March quarter, Australian economic activity has recovered to be above pre-pandemic levels and has grown 1.1% through the last year. Within that, private investment rose 5.3% and contributed 0.9 percentage points to growth. Machinery and equipment investment recorded its strongest quarterly rise since December 2009, driven by the continued improvement of business confidence and support from government tax incentives. I think more the latter than the former. The rise in machinery and equipment investment was widespread and observed in both the mining and the non-mining industries. Dwelling investments increased for the third consecutive quarter, rising 6.4%. No surprise there. The rise is consistent with the recent surge in building approvals as households took advantage of the home builder scheme. The gross value added, the GVA, of the construction industry rose 4.4% and recorded the strongest contribution to growth across all industries. Household spending increased 1.2% and added 0.7 percentage points to growth, and spending on services rose 2.4% as COVID-19 restrictions continued to ease around Australia. Spending on goods declined 0.5% but remained above pre-pandemic levels. The household saving to income ratio fell slightly but still remains elevated at 11.6% as the rise in household spending outpaced the growth in household income. Compensation of employees rose 1.5% as employment and hours worked, and that grew by a brisk 1.8%, with underlying activity in the economy expanding. A fall in benefit payments detracted from income growth, of course, reflecting a decline in the number of recipients and also the winding back of additional COVID-19 support payments during the first quarter. Now let's look at property. Figures released by SQM Research revealed that national residential property listings dropped in May 2021 by 6.3% to 245,953 from 262,617 in April. And old stock is being cleared nationwide as the number of buyers outstripped sellers during this property boom. The largest monthly falls in property listings were in Canberra, Melbourne, Brisbane and Adelaide, as stock levels trend downwards, particularly in regional locations around Australia, which is putting pressure on asking property prices. Compared to 12 months ago, listings fell 19.2% across the nation, with the biggest falls in Hobart, Adelaide, Canberra and Brisbane. Nationally, new listings, which means less than 30 days old, fell 2.4% over May 2021 to 79,673 properties on the market, though they rose 54.1% over the year. New listings dropped the most in Canberra and Melbourne, down by 7.5% and 6.8% respectively. Perth and Darwin went against the trend, and postings rose in those, up 2.9% and 1.5% respectively. Over the year, new listings rose the most in Darwin by 131.9%. In a sign that older stock is clearing, property listings over 180 days dropped by 9.2% in May, and they are down around 44% over the year, with falls posted recorded in all capital cities and particularly large falls in the smaller capital cities. Louis Christopher, Managing Director of SQM Research, said property listings fell in May due to strong market conditions. We have also seen a big fall in old listings during the month, indicating that old stock is getting moved everywhere. The downward trend in old listings suggests strong absorption rates, so new property listings are not completely offsetting the falls in old listings, indicating that there are more buyers than sellers in the market, which is fueling the property boom. This is contributing to strong growth in asking prices, particularly in regional and coastal locations such as the New South Wales Mid-North Coast and on the Gold Coast. The trend is also pronounced in the inland regions such as the Murray region. With low interest rates set to remain over 2021 and many households awash with cash as the jobless rate continues to fall, we expect to see sustained gains in house prices over the remainder of the year, he said. Over the month to 1 June 2021, national asking prices rose by 1.7% for houses, but fell 0.2% for units. And over the year, strong growth in national asking house prices were 14.2%, led by gains in Hobart and Sydney. Asking unit prices rose 6.6%, but that was pushed up by rises in the smaller capital cities and regional locations, with an oversupply of units in Sydney contributing to an annual fall in asking prices there, and minimal growth in Melbourne. Capital city asking house prices rose just 0.4% over the month to 1 June, while unit prices slipped 0.4%. And over the year, unit asking prices in capital cities have fallen 2.1%, reflecting falls in asking prices for Sydney units, down 5.1%, as oversupply swamps the market. Capital city house prices rose 5.3% over the year. The Reserve Bank of Australia has warned that it's monitoring lending to property investors as borrowing by real estate speculators picks up and residential housing construction booms. It tweaked its discussion around housing market conditions and explicitly called out the greater role investors are now playing in the booming property market in the notes released yesterday. Housing credit has picked up with strong demand from owner-occupiers, especially first home buyers, the RBA wrote in its statement. There has also been increased borrowing by investors. Given the environment of rising housing prices and low interest rates, the bank will be monitoring trends in housing borrowing carefully, and it is important that lending standards are maintained. And data released on Tuesday show that Sydney's median house price surged to a record in May after jumping 3.5% in just 1 month, the largest increase across all capitals as fierce demand outpaced supply, particularly for blue-chip properties. Melbourne and Brisbane gained 2.2%, Adelaide and Canberra were up 2.1%, and Hobart was up 2.7%. Across the combined capitals, house prices rose by 2.6%, while the regions climbed by a lower 1.9% during the month. But now compare this with New Zealand, where tightening is now biting. The average asking price for properties listed for sale on property website realestate.co.nz has declined for 2 consecutive months, providing further evidence the housing market is cooling over there. The average asking price for all of the residential properties listed for sale on realestate.co.nz in May was $841,193 New Zealand dollars, down by $22,203 from the March average of $863,396. It was the second month in a row that the national average asking price on the website has declined. Other regions where the average asking price was lower in May than it was in March were Northland, Coromandel, Waikato, Bay of Plenty, Hawke's Bay, Central North Island, Waipaera, Melbourne, Canterbury and Sutherland. The number of new listings received by the website has also declined for 2 straight months, from 11,322 in March to 8,760 in May, and the total number of properties available for sale on the site declined from 19,437 to 14,883 over the same period. Just note that the prices quoted in the article here are the non-seasonally adjusted averages, which means that they may vary from seasonally adjusted prices quoted elsewhere. In Auckland, the country's largest property market by a substantial margin, the average asking price also declined for the second month in a row, from $1,132,716 in March to $1,105,365 in May. That's a decline of $27,081 over 2 months. Now, I want to stress again, the main driver of home price growth is freer credit availability. When you ease that via lower rates or lending standards, prices bubble higher. The reverse is also true. When you tighten standards, as New Zealand has done, prices ease off. Nothing to do with supply of property, all about the credit lever, the one the RBA denies even exists. One reason why I suspect the government here is going to try to get the responsible lending provisions removed, and why I don't expect macroprudential anytime soon here in Australia, as they need property to continue to bubble. Hence the wet lettuce. Given the environment of rising housing prices and low interest rates, the bank will be monitoring trends in housing borrowing carefully, and it is important that lending standards are maintained, in the governor's statement yesterday. There was one change in the RBA statement that caused some confusion among market participants. It was the RBA's decision to omit a sentence included in last month's post-meeting statement that highlighted the central bank's preparedness to undertake further bond purchases to assist with progress towards the goal of full employment and inflation. Commonwealth Bank economist Gareth Ed said that the omission did not signal the end of the RBA's bond buying programme, while Jarden chief economist Carlos Cacho said it was supportive as his expectation that the central bank will announce a tapering of its bond purchases next month. In fact, John Kehoe, economics editor at the AFR, wrote a good piece on the RBA statement headed "RBA sees skill shortages but no signs of wages pressure." While businesses complain the international border closure is causing skill shortages, the RBA is seeing no firm evidence this is showing up in higher wages. The economy continues to outperform expectations, but the Reserve Bank of Australia wants to be confident that this will show up in wages and inflation before dialing back its extraordinary monetary stimulus, he wrote. The monthly RBA board meeting statement by Governor Philip Lowe added a new sentence: "There are reports of labour shortages in some parts of the economy." Yet while business complains about the international border closures causing skills shortages, the RBA is seeing no firm evidence so far that this is showing up in wages pressure. Employers may be holding out for the relief value of international borders reopening to get access to skilled labour, rather than permanently ratcheting up the cost base of their workforce. Therein lies a dilemma for the RBA. It is seeing a rapidly improving labour market. Progress in reducing unemployment has been faster than expected, with the unemployment rate declining to 5.5% in April, Lowe noted. Job vacancies are at a high level, and a further decline in the unemployment rate to around 5% is expected by the end of the year. But the RBA is waiting for this to translate into higher wages and price pressures. Despite the strong recovery in the economy and jobs, inflation and wages pressures are subdued, they said. While a pickup in inflation and wages growth is expected, it is likely to be only gradual and modest. The RBA was in a holding pattern at its Tuesday's board meeting, no doubt narrowing down its policy options for its crucial July meeting. Financial market traders went into a flurry of speculation over a tweak to the RBA's language on its plans for the $200 billion quantitative easing program. The RBA said it would consider future bond purchases beyond September, whereas last month the Reserve Bank said it was prepared to undertake further bond purchases to assist with progress towards the goals of full employment and inflation. Now, some RBA watchers viewed the change as a dovish tilt to further $100 billion of bond purchases, whereas others viewed it as a hawkish signal on likely tapering. Yet markets may have over-interpreted the change in language, which was probably not intended to convey a particular direction. First, the RBA will decide next month whether to extend its 0.1% yield curve target from April 2024 to November 2024. Extending it would imply the RBA believes the 0.1% overnight cash rate won't rise until after 2024, an arguably dovish tilt from its current guidance that a rate rise is unlikely to be until 2024 at the earliest. For credibility reasons, the RBA would want to be fairly confident that the cash rate was not going to increase until after 2024. Well, that's possible. If the labour market continues to improve, it's perhaps not a scenario the RBA can stake its credibility on. Though finely balanced, extending the yield curve target seems a bit less likely. Second, the RBA will decide the size of the third tranche of its government bond buying programme beyond September. The RBA is midway through buying $200 billion of bonds over the programme's initial 10 months to suppress long-term bond yields. Quantitative easing will continue in some shape or form, therefore. The easiest option will be to add another $100 billion at the existing pace. Another option, though, is to introduce some flexibility to the $5 billion weekly bond purchases. The RBA has historically liked to have flexibility on monetary policy. The final option is a smaller amount of bond purchases over the next 5 months. The RBA will have noticed other central banks in Canada and New Zealand signalling policy tightening well before 2024. Yet Canada is already around its 2% inflation target, and New Zealand unemployment is a low 4.7%. On the other hand, Westpac thinks the RBA is turning talk towards easing back on QE too soon. According to a note from their economist Bill Evans, as expected, the Reserve Bank Board kept its policy settings unchanged at the June board meeting. The key talking point from the governor's statement was the admission of the bank is prepared to undertake further bond purchases to assist with progress towards full employment when discussing its deliberations for the July board meeting. At that meeting, it will decide on the future of its QE and yield curve target programme. There are at least two ways to interpret this admission. Either the board felt that the inclusion of the sentence unduly locked them into a commitment to extend QE before the July meeting had even begun, or there is a clear intention to dissuade the market from expecting further QE. Setting a level playing field for market expectations is a reasonable approach, but it comes with uncertainty as to how the market responds. Of course, we should also recall a recent speech from Deputy Governor de Bail, when he asserted that it is the total size of purchases that affects bond yields and financial conditions, including the exchange rate, rather than how many bonds the central bank is buying each week. He did not discuss the rationale behind that assertion, but it is important for us to be aware of the thinking of those who are pulling the levers. This adjustment follows at least two others in the last month, which strengthened the case for a hawkish outcome in July. When discussing the factors that will impact the decision in July, the April minutes referred to members would give close attention to the flow of economic data and the outlook for inflation and employment. That guidance aligns with our views that the decisions will be largely determined by the board's economic forecasts. And it's Westpac's view that the board's latest forecasts are not consistent with the board expecting to meet its tightening conditions until late in 2024 at the earliest. However, surprisingly, the May minutes referred to the flow of economic data and conditions in financial markets, no reference to their forecasts of the timing of the likely achievement of their rate hike conditions. And consider the final sentence. This is unlikely to be until 2024 at the earliest. But even that comment has been watered down from the much stronger "the board does not expect these conditions to be met until 2024 at the earliest" in the government's April statement. Of course, this gradual evolution of the bank's rhetoric coincides with the falling unemployment rate at the time of the April statement. Unemployment stood at 5.8%. Never mind that the current 5.5% follows a negative employment number offset by a 0.3 percentage point fall in the participation rate. The one area in the June statement which attracted some caution was around the re-emergence of the virus. This issue had not been discussed for some time. An important ongoing source of uncertainty is the possibility of significant outbreaks of the virus, although this should diminish as more of the population is vaccinated. No doubt, along with the GDP report, the confidence measures and the board employment report, the board will be closely monitoring developments in Victoria. Reasonably, it should also be at least considering risks of ongoing shutdowns in its forecasting process. On housing, the evolution of the investor is the most notable change. In April, the governor noted investor credit growth remains subdued. In May, only owner-occupiers and first-home buyers were assessed as strong, but in the June statement, there has been increased borrowing by investors. And so the conclusions are that the board has surprised the market by excluding the long-held positive assessment of QE. There are at least two ways to interpret this, but the market will likely now downplay the prospect of a QE expansion. Westpac has long held the view that despite the faster-than-expected pace of recovery, 2021 is not the year to start tightening policy well before other major central banks. The board's own forecast and statements of unlikely before 2024 at the earliest points to adequate time to, if necessary, err on the side of overstimulus. Potential imbalances in the housing market can be addressed with macroprudential policies when considered necessary. The RBA's underperformance on its inflation target for so many years and the wide gap between actual annual trimmed mean of 1.1% and target 2.5% sustained signals a relatively greater need to maintain currently high stimulus settings than other central banks. So we will not have much time to await the decision in July, and today's statement has to be taken very seriously, he said. I'm amazed how every statement and every sentence in the RBA statement is parsed by economists, some sort of mysterious rite where they try and decode that particular word to interpret it to mean that particular thing. It's almost a religious rite. I find the whole thing rather ridiculous, frankly. So I don't know what the Reserve Bank is really up to, other than it's going to do more QE, quite clearly. It's going to keep rates low for long, clearly. It's going to encourage more housing lending, clearly. And all of that is going to put upward pressure on home prices ahead, although the early signs of rising mortgage rates and some changing dynamics in terms of supply and demand in property appears now to start to come through. So we'll see just how strong the property market is in the months ahead. And over the longer term, I still expect things to be somewhat weaker in the next couple of years. And finally, is crypto making the mainstream? Well, according to the US 2021 Trends in Investing survey, conducted by the Journal of Financial Planning and the Financial Planning Association and supported by OnRamp Invest, while advisors in the US remain cautious about digital assets or cryptocurrencies, it seems that they may be ready to embrace them due to client demand. Their 2021 survey received 529 responses from financial advisors of various backgrounds and business models, and 54% are certified financial planners, 40% indicated that they work as an independent advisor, and 26% say they have more than 21 years of financial services experience. Cryptocurrencies were first added to the survey in 2018 when only 1.4% of advisors indicated they were currently using or recommending them to clients. That percentage dropped to below 1% in 2019 and 2020, but it's increased to 14% of advisors currently using or recommending cryptocurrencies in 2021. But it seems advisors' use of or recommendations of digital assets may be trending upward for the foreseeable future. According to the survey, more than a quarter, 26% of advisors indicated that they plan to increase their use or recommendation of cryptocurrencies over the next 12 months. And 49% of advisors indicated that clients had asked them about investing in cryptocurrencies in the last 6 months, up from 17% in 2020. It is clear from these results that we've reached an inflection point in the wealth management space. Advisors now faced with a client base that demands knowledge, access and advice from their advisors on crypto assets, says Tyrone Ross, CEO of OnRamp Invest. And speaking of what's trending, this year's survey also asked clients about their and their clients' participation in GameStop that dominated the news cycle in the early part of the year. Not surprisingly, most advisors indicated they didn't buy shares of GameStop, and neither did their clients. However, 34% of their clients did buy shares of GameStop, and 20% themselves bought shares. Digital assets were not the only focus of this year's research. Each year, the survey looks at where financial advisors are investing today and where they plan to increase and decrease investments over the next 12 months. Exchange-traded funds continue to wear the crown as the preferred investment vehicle by financial advisors, with 64% currently using or recommending them. However, advisors' use and recommendations of ETFs is down 21% from the 2020 survey, but 36% said they will increase their use of ETFs over the next 12 months. Each year, the survey explores which investment vehicles advisors will also decrease their use or recommendation the most. As in the case every year, most advisors do not plan to decrease their use or recommendation of any investment 28%. However, advisors are planning to decrease their use of individual bonds down 21%, non-wrapped mutual funds at 20%, mutual fund wrap programs at 9%, and fixed annuities down 9%. Those are all increases from the 2020 survey. With most of the public poorly informed about what digital assets are, I find it comforting that more financial advisors are involved in conversations about the topic and the role such assets should or could have in clients' portfolios, says Dan Mossad, the CFP practitioner editor of the Journal of Financial Planning. The 2021 survey also indicated that clients were asking less about the effects of general volatility, down 52%, and COVID-19, down 62% on their portfolios than they were in the previous year. And other key findings from the 2021 Trends in Investing survey include that just as clients have raised questions over cryptocurrencies over the past 6 months at 49% of clients have been asking about the effect of tax reform on their portfolios. While the majority of financial advisors continue to favour a blend of active and passive investment management at 58%, it appears a purely passive approach continues its downward trend, with only 18% of advisors preferring a passive approach compared to 24% in 2020 and 29% in 2019. 74% of advisors re-evaluated asset allocations over the previous 3 months due to anticipated changes in the economy, 56%, and market volatility, 44%, but 39% indicate that they continually re-evaluate their allocation strategy. Addressing tax concerns represents an opportunity for financial planners to be of great value to clients. Taxes are easily one of the largest expenses clients will pay in their lifetimes, added Mossad. A full report of the 2021 Trends for Investing survey is available for download, and I'll put a link in the comments below. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.